And so what I'm saying here is that the central banks appear to have woken up, but their moves will not save their gold derivatives, which are the currencies. They will all die. And since the central banks have woken up, it's only a matter of time until the public does, and they will buy silver, just like the central banks are now buying gold. But for most of them, it will be too late because the stackers will already have what they need, and it'll be up to us to distribute it, not for other currencies, but for goods and services directly, because it will be the money by which the division of labor is maintained, and whatever remains of society after this is done is salvaged. Everything will be fine, but there will be chaos in the short term.
Rafi Farber is the publisher of The End Game Investor, a prominent daily market commentary that gives insights on precious metals. In this video, Rafi Farber attributes gold's outperformance to increased central bank purchases and worries about the lack of awareness regarding silver's role as public money during a financial crisis. As November commences, silver has remained under pressure, shadowing the market fatigue evident in its more illustrious counterpart gold. While gold briefly touched the $2,000 mark last month, lifted by geopolitical tensions in the Middle East, silver failed to ride the coattails of this surge with the same vigor. While silver has bounced off its recent lows, the white metal continues to underperform gold. And when volatile areas of the precious metals market showcase weakness, silver and mining stocks, it's often an ominous sign for the entire sector. Meanwhile, Rafi states central banks' increased gold buying since 2022 is driving gold's strong performance. The quarter's demand of 1,147.5 metric tons, however, stood 8% ahead of its 5-year average, and official sector purchases in the full year are expected to approach their 2022 level, the World Gold Council said in its quarterly demand trends report. Central bank purchases for the first 9 months of the year now total 800 tons, driven mainly by China, Poland, and Singapore, as well as unreported buying. The pace has exceeded the amount for the same period of last year, which ended with record demand. Furthermore, he claims that central bank gold buying can't prevent currency collapse during hyperinflation. Now, we present the clips of Rafi Farber insights from his recent video. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
But for now, why is gold outperforming silver? If we are on the verge of a financial catastrophe, the dollar should be strengthening, and it is. So why is gold outperforming? And this might be the answer. Why gold is outperforming silver? We have this chart from Bloomberg that says buying binge. Central banks continue to buy lots of gold, and this is true. We're going to put this in context in a second. So the appetite of central banks for gold has increased dramatically since 2022. And this central bank gold buying, since they don't buy silver, silver is not worth it for them, hefty of a commodity, and it doesn't have enough concentration of value. Gold is the bank's money and silver is the public's money. The public has not woken up yet, but it might be the central banks have, but it's not going to help them. We'll get into why in a second. The paragraph here from this Bloomberg article to which this chart was attached says countries expanded bullion reserves by 337 tons in the 3 months through September. The World Gold Council said in a report Tuesday that follows an increase of 175 tons in the second quarter, which was bigger than the council's previous estimate of 103 tons. So central banks are buying more gold than the council, whoever that council is. I don't know what the council, who's on the council? Anyone on the council? I don't know who's on the council, but they say things and apparently it's important, whatever. So why doesn't this matter? It matters for the gold price in the short term, but it doesn't really matter in the long term. It's not going to save any currencies, and here's why it won't. This is the long-term chart of gold purchases and liquidations going back to 1950. So we see here that from 1950 to 1964, I think this is the London gold pool over here collapsing. Right here in 1968, 1969, this is when they sold a bunch of gold to try to keep the gold pool at a constant price. And that was like the eve of the collapse of Bretton Woods with gold at $35 an ounce and the closing of the gold window by Nixon. So there was a whole bunch of gold buying in the 1950s and early 1960s. And then big sales, and then pretty much nothing. There was like net sales, mostly net sales from 1968, the collapse of the gold pool, until 2009. And now, yes, central banks have been buying gold since 2009 every year, and whoop-de-doo, and it's great for gold, and that does have to do with gold's rise. It's not disconnected completely, but no, it's not going to save any currencies, because even as central banks have been buying gold since 2010, it has not helped any currency. The currencies are collapsing in real terms. Hyperinflation is at the door. Why doesn't it matter? Because if the currencies are not directly convertible to a fixed amount of gold, the amount of gold on a balance sheet of a central bank doesn't matter because people won't trust it if it's not convertible, and it won't be. So central bank gold buying is really irrelevant in the long term or even in the short term now if the end game is short term away, and it could be. So it affects the spot price, but it does not save the currencies. I guess that's the best of both worlds.
Rafi Farber foresees the reverse repo market facing ongoing drain, and this could affect Bank of America's securities in particular. Fed policymakers have said the banking system's lowest comfortable level of reserves is roughly 8% of gross domestic product, which includes a small buffer above the level in September 2019. However, strategists, including Bank of America's Mark Cabana and Katie Craig, have said recent bank liquidity preferences may imply scarcity closer to when reserves are about 10% of GDP, which means QT might end once balances at the overnight reverse repo facility, or RRP, reach zero near the end of 2024. As per Farber's expectations, gold and silver are poised to soar as safe havens, driven by Fed money printing. Let's get back to the interview.
I want to show you what was happening on October 31st. October 31st is significant because it's an end of month day. The end of the month is typically a day when banks rebalance their books and put a lot of money into the reverse repo facility. So there's typically a spike up at end of month. So I highlighted the October end of month days for the last 2 years. And they are October 29th, 2021, because October 30th and 31st was a weekend. So this was the last business day of October 29th on that book balancing day. And reverse repos went up $117.6 billion on Monday, October 31st, 2022. See another spike here. They were up $92.169 billion. Now look at Tuesday, October 31st, 2023, this week. RRPs, even though it was a book balancing day, which means that RRPs typically go up, spike high heavily on book balancing end of month days. This did not happen here. The reverse repos were still down $338 million on the last day of October 2023, and they fell by $57 billion yesterday, which is November 1st as I'm recording this. So my point is, if the RRPs cannot replenish themselves on book balancing days, it means that they're going to continue to drain fast. And I think that drainage will increase in rate once the Treasury auctions begin again on November 7th, and the Treasury has issued its refunding requirements, and they're going to increase the size of auction. I think they plan to raise something like $776 billion net this quarter, or it could be 1.5 trillion, but whatever it's some gargantuan number that is going to drain the rest of this stuff. And when they do, there are going to be no more emergency dollars to borrow for treasuries, and interest rates are going to skyrocket. And that is when a cash run could happen in the big banks, and Bank of America could be in trouble and be forced to sell its held to maturity securities. Because what is the difference between available for sale and held to maturity? It's just an accounting gimmick. There's no law that says they can't sell these things. They just don't plan to, so they can pretend that they have it at face value, even though it's not face value. But that was a new regulation, I think, after the 2008 financial crisis or something. They make up new fake rules that aren't in tune with reality, and they wonder why they're not in tune with reality, because you can't just wish away the law of gravity, just like you can't wish away the laws of economics. It's the same thing. And how is this related to gold and silver? Well, when there is a run on cash, that means the Fed has to print one last time, and they will do it immediately this time. And I believe that the moves that gold and silver will make when that is done to prevent banks like Bank of America from completely failing will be so extreme that they will shock even the most ardent of gold and silver bugs and bulls like myself. There will be no time to chase.
The assertion made by Rafi Farber stating, "Silver is the public money. The public has not woken up yet," offers an intriguing view, highlighting silver's potential as an accessible form of wealth for everyone. In the meantime, central banks' growing fondness for gold has lifted the precious metal's significance as a cornerstone reserve asset. What is your perspective on gold's future as a hedge against financial instability? And do you see yourself investing in either gold or silver in the coming future? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.